Hey everybody, this is Dave Zazinski, Z-Team eXp Realty. I'm going to shoot a quick video, share some information with you. I've just had a lot of people reach out to me about what's going on in the market, and I thought I would just provide some insight as to where the Phoenix market is and share some things with you. A lot of you know I started my real estate 16 years ago, and I got to see the run up in the 04, 05, 06 market, and then the decline with the '08 crash, and did a tremendous amount of short sales. So I saw both the boom in new home sales starting there and then in the short sales. So I just want to offer some perspective and give you guys some real data that you can compare. So I'm going to share my screen here and we can get into it. So first of all, let's get in here. This is not to promote the real estate market. We're all kind of in a worrisome time right now, but I just, with the uncertainty, I thought I'd share with you what the real numbers are, just so we can put it there. And everybody we're working with, we're on everyone's timeline. If people want to take a pause, we understand. The reality is some people just absolutely need to move, and that doesn't change even in the light of a pandemic. And I think it is very necessary to have real estate be an essential protected business, because people just still need to move on with their life. People are being transferred. People are having needs in their life that require and necessitate a home move. So it's important to look at that. But there's a lot of good news to look at. So just looking at the big picture, housing crisis and recessions rarely go together. And so when you look at the last 5 recessions that the US has gone through, this is courtesy of CoreLogic with their data, you can see 3 economic recessions equated to home values going up. 1 went down less than 2%. And then we all remember '08. I really think that's where a lot of fear is we have really been scarred by the 2008 housing crash, and it traumatized a lot of people. I think it's the right word. It wasn't just, oh, that was tough. It was traumatic and greatly affected people. So I think we all have right to be concerned. I went through it. We lost our home, had to do short sales. It was a scary time. So I don't think anybody wants to see that again. But if we look at some highlights, COVID-19 is what's causing this, and it's not like what we saw in '08. So all things being considered, it does not equal a housing crisis, and this certainly will not repeat 2008. And here is some projections from 3 major financial institutions: Goldman Sachs, JP Morgan, and Morgan Stanley. So everybody certainly agrees that Q2 is going to look awful. I think Goldman Sachs had initially come out and said a negative 24% GDP, and I think they revised it to a 35 negative GDP. But then Q3, they also revised upwards. So I believe that's a 12% increase in Q3. And reading this here from a recent study from John Burns Consulting notes that past pandemics have created V-shaped economic recoveries. So, and they've had very minimal impact on housing prices when we've looked at past pandemics. So who knows what this one's going to look like, but we're just basing it off the models of the previous one. So there is a lot of hope and optimism. Here is a survey of 50 leaders done through PricewaterhouseCoopers survey, and so when asked, how long do you think it would take for your company to get back to business as usual? 66% said less than a month, and 90% said it would take between 1 and 3 months. 10% thought it would take longer. So the overwhelming majority, 90%, said within 30 to 90 days, we're going to be back to normal. And that is the big difference between what we experienced in '08. So Robert Dietz, who's the chief economist of the National Home Builders Association, I think he nails it here with what he says is that the housing sector is underbuilt rather than overbuilt compared to last time. And we really did have that last time, with home builders speculating, building a lot of homes that they could sell, and then buyers coming in and speculating. I was selling new homes for a large publicly traded builder up until 2008. So I was witnessing and people come in and buy 25 houses, or an investor would bring in a busload of people and they would all buy 4 or 5 houses. And most of these people were school teachers, hairstylists, whatever. People were just buying, not your typical prototypical investor. Not to say that school teachers and hairstylists can't do that, but their incomes did not match what they could buy. And lenders were saying that's okay, just state your income. We had no income, no job, no assets. So ninja loans is what they were referred to back then. You could literally have no income, no job, and no assets. And if you just wrote down a number and could fog up a mirror, they say, okay, we'll believe you. And loans were given out that way. And we just don't have that right now. So we had all of these people who could not afford their loans and they were just hoping to buy and flip, buy and sell. We just don't have that going on right now. So we really see housing will be the tailwind to get this economy going again, and not the headwind that we saw in 08 that was bringing it down. Interest rates over time, this is just a good snapshot. If you're not familiar what interest rates were doing, they play such a major role in housing, and we've never had a better time for interest rates than right now. So one thing I put out there was a year ago, your average borrower was paying $80 more, even though home prices were about 8% lower. So with a median home price of close to $300,000 in Arizona, going up 8% is $25,000, but yet they're still paying less. So home prices are up $25,000, and payments are down $80 because of what interest rates have done. So having a 5-decade low interest rate environment is going to help this. So what's going on in Arizona? There's a lot of data. Just going to kind of summarize. I'm not going to go through this, and then I'm willing to share this slide with anybody so you can look at it. But supply versus demand, that's what controls pricing just about everything we do. And it's going to be a seller's market for several more months to come. We have to look at housing as a super tanker or a Titanic. It just doesn't turn the corner really quickly. It just takes a long time to get that thing to turn. And so it's starting to turn, and we'll look at some of those lead and lag measures, but it's probably a good thing. We've been in such an unbalanced market for so long. This might be what we need to get some normalcy, which I think everybody who was scarred by 08 would probably appreciate. So some of the key findings in here is we have more new listings, particularly under 400,000, which is great news for people who have been struggling to get homes. And part of that too is Opendoor, OfferPad, Zillow has hit the pause button. So they were eating up a lot of the inventory in that price range, and now they're gone. So new listings plus those 3 major buyers are out is going to help people in that price range. And so and we have a solution for that. If people are still looking for that, we work with a number of investors that still want to buy for buy and holds, but the 3 biggest players are gone for now. New contracts are getting signed, more contracts are canceled, and more have fallen through, and we have fewer sales closing. So the Cromford Market Index is down negative 5.8, which is a big swing from where it was 2.6, up 2.6 a week ago. But again, sellers have a clear advantage, and there's just no downward pressure on prices, and that won't happen for a while. It's going to take several months before we get balance, and we'll go into that a little bit more. But let's look at April 2020 to April of 19. Active listings are down 30% from a year ago. So we're still very compressed on the active listings, but we're up 20% from a month ago. So we're starting to see that trend. Active listings, if you include UCB, which is under contract accepting backup, and CCBS is contract contingent on the buyer sale. So the buyer has a home to sell. That is down. So our active listings are down 26%. So we had 23,399 a year ago. We're down to 17, but we're up 9% from last month. So compared to a year ago, we're really under, we're compressed on the inventory, but we're starting to see a trend. Pending listings are down 12% and from a year ago, and down 15% from last month. So that's the biggest trend that we're seeing the difference of. And then monthly sales, we had 8840 versus 8489. So we're still up from last year and up from last month. And those monthly sales prices are going to keep the price going up. As long as we keep selling, sellers can still keep dictating terms. So I like to look at lead and lag measures like dieting. You know, you go for a run and you start working out, you're not going to see results right away. But if you continually do that activity, you'll start to see a change. And so, you know, the lead measure is your diet and going to the gym, and that lag measure will be the inches and the pounds that come off later. So pounds and inches aren't going to come off on price for quite a while, but if those lead measures continue, eventually they could. If we're still in a economic crisis 6 months, 9 months, or a year from now, obviously we'll start to see changes. A lot of data here. This is something you can go through later, but the big thing that I'll put in here is that it just shows how resilient the housing market is. When the housing market's not the cause of the recession, it's very resilient because people still have to get from A to B, from an apartment to a home, or from a large home to a smaller home. You know, people we're working with, I'm dealing with, you know, an 85-year-old who is going to move in with her son and daughter-in-law, and that just needs to happen, regardless of the economic conditions. It's time for her to move in with them, and so they're selling. And then families that are growing, they just need that extra space. So those things are going to happen, and the housing market stays pretty resilient when, again, it's not the cause of the recession. So we're going to see some changes, but home prices in Arizona have gone up 13% over the last 12 months. And so a lot better than what 401ks are doing right now. And so as long as we come out of this as expected, we don't anticipate any changes. So here's some real data to look at really quickly. And like I said, there's a long way to go and many, many months to create a balanced market. So one of the things that we look at for a balanced market is our month supply of homes. Typically, and what that means is how many months would it take if nobody put their home on the market and we just worked with the 17,000 homes we have for sale. We know that in 2 months, they're all gone because we're selling about, you can see 9,000 homes were sold this month. So 9,000 homes, well, between the active and the UCB, they're going to be gone in 2.1 months. What should be here for a normal market is about 4.5 to 5 months of inventory. So we want to see that pace up 2.5 times that. And a year ago, we were at 2.8 was our actual, let me go back, was our actual number. So go back here again. So with 23,000 homes for sale and another 4,900 UCB, we were still only at 2.8 months supply. Very small supply. Right now, 2.1. So it's going to take some time for that supply to build up before we can start getting into a balance of 4 to 5, where we're really on equal footing between buyers and sellers. Buyers market, we would need to see to get above that 5 into the 6, 7 month supply range. And there are markets inside of markets. So sometimes we are negotiating for our clients and there is a 7-month supply. And that's where we can say, hey, Mrs. Seller, we're not going to do this, or we do have options over here. And, you know, we see that in the $800 to $900 million range where we do have options with that month supply. But for the average, we're well below what's normal. So so some more of those numbers there. You see the days, days on market is down 79 days, where it was 97 a year ago. And the monthly appreciation is up 7.6, where it was 6.9 last year. Average sales price to list price. So how much is the seller getting? If they've got their home listed for 100,000, they're getting 98,350, where a year ago they were getting 97,300. So you can see all those numbers are still there, and it's going to take some time to put pressure on those. So I hope that helps. I don't want to just go out and say it's all rainbows and sunshine and everything is great because we're dealing with a very serious pandemic. But the housing market here is extremely robust, is extremely favored towards the sellers. And I think this is some good news long term to have some pressure relieved, so we don't continue to see just a 13% run up because of the affordability issues, where we have to keep dropping interest rates, because if we go up 10%, we can't keep interest rates where they need to be. So I think this is going to stabilize the market a little bit more, which I think is a good thing. Extremes on either end aren't good. It's been great if you're a seller. We've all made a lot of money if you own a home. Over 53% of homes across the country have positive equity of 50% or more. And that's a staggering number. So there's a tremendous amount of equity in people's homes right now because of what the market's been doing. But it's also been very tough for buyers to get in. So if you've got any questions on what's going on, feel free to reach out to me. I wanted to get this out to my clients. If you're not one of my clients and somebody shared it with you, no problem if you call me or send me an email. And if I can help break down something for you to help you understand it, I'm more than happy to do it. Stay home, stay safe, wash your hands, and just remember, this too shall pass. We're going to get through it and we'll come out better. So hope that helps, and let me know if I can help you in any way. Thanks. Bye-bye.